Good morning, ladies and gentlemen, and welcome to MacroAce with your host, Tony. I'm also the head financial analyst at FinancialJuice. Let's go through the Bank of England prep, and shouldn't take too long. And we do also have the ECB rate decision later on, which will be covering them from 7:45 a.m. Eastern Time. But yeah, let's get into it with Bank of England, and first start off with what it is. It's that the rate that banks pay interest to commercial banks, and of course, similar to the FOMC, usually held, the rate decision is usually held every 6 to 8 weeks or so, and of course can have major implications for the economy and also for their international business and trade as well. Now, why is it important? Of course, higher rates means central bank is trying to slow down growth or make sure it doesn't get out of hand. That's also the same thing with inflation, which is the current thing that the central bank is trying to get under control. And when lower rates occur, or when the central bank cuts rates, that's actually usually done to support or create growth within an economy as well. Now, of course, the median expectation is for the central bank to remain pat at 5.25%. So even with no rate change, the focus is going to be shifted onto the rate statement itself that is provided by the Bank of England. Now, that doesn't mean that the central bank can't surprise the markets with a potentially another rate hike or even a rate cut. But the idea of a rate cut is way too far out there, enough to be able to confidently say, yeah, that they could discuss or they could cut rates today. So I can see somebody in the comments, John, saying cut. No, you never know. But anyway, so as I was saying, that's how the markets are affected, and also the economy is affected by the central bank's decision, whether they go with higher rates or low rates. Those are the usual effects. For the currency market, usually you see a strengthening in the pound if rates are higher than expected, or if the rate statement is more hawkish than what traders are expecting. And then if the central bank does decide to lower rates or provides a more dovish than expected statement, that will then lead to the pound seeing weakening instead. Now, if we carry on, so as I said, it also affects banks handing out loans, mortgages, and credit. So where is the economy at the moment then? So the unemployment rate was unchanged at 4.2%. The unemployment change was at 16k compared to 17.8k. Average weekly earnings year on year was at 7.2% compared to 7.9%. And off the back of that data that we had this week, the pound did weaken. Again, average weekly earnings representing the wage price pressures that are in the economy. So it was seen as a positive sign that the wage price inflation side is heading lower, albeit still quite strong. But it did cause a depreciation or bearish reaction for the pound off the back of that data. Inflation at 4.6% compared to 6.7%, so a nice big old chunk decline in the inflation data. Core CPI declined to 5.7% compared to 6.1%. GDP third quarter was at 0% compared to 0.2%. Year on year was unchanged at 0.6%. And the GDP estimate month-on-month figure that we had this week as well was weaker than expected, and also compared to the prior at minus 0.3%, which also led to repricing from investment banks, but also led to a weak reaction from the pound as well. Services PMI was at 50.9 compared to 49.5. Manufacturing PMI at 47.2 compared to 44.8. And retail sales year on year was at minus 2.7% compared to minus 1%. And then the month on month was at minus 0.3% compared to minus 0.9%. And the previous rate statement from the Bank of England, so the Bank of England forecast shows inflation in 1 year's time at 3.1% compared to the August forecast of 2.82%. based on market rates and modal forecast. And for the 2-year inflation expectation was at 1.9% compared to 1.65%, again based on market rates. Now, this is what caused a bit of the strength in the pound when the rate statement had come out. The rest of the statement itself wasn't really anything of surprise or anything that came out of the blue. Even this statement itself, albeit higher expectations for inflation, there wasn't. It would not have been seen as a real surprise, as the central bank still has ways to go to bring down inflation within the UK. But from this slightly more hawkish than expected expectation for inflation in the UK, that led to the pound seeing a bullish reaction off of that data. Okay, policy. They also said that policy likely needs to be restrictive for an extended period of time as well. So this is the previous sentiment that we had of Bank of England members. Now the expectation is for a 6-3 vote in order to keep rates unchanged. So 6 members looking to keep the rates unchanged, and 3 members looking to hike by another 25 basis points. So these 3 on the right hand side, Megan Green, Jonathan Haskell, and Catherine Mann, voted last time to raise rates by 25 basis points. And it's the same thing that's expected this time round as well, with Megan, with Green, Haskell, and Mann. The only difference is that you can see this shift from Ramsden. So for Ramsden was on more of the tightening side at the last meeting. This time he's shifted towards the more he's going towards the other side, more leaning towards the hold side, or let's say the neutral zone. So then how should you interpret that? So the way it should be interpreted is that the majority of central bank members at the Bank of England are still in the camp of keeping rates unchanged before they decide to make any decisions about talking about rate cuts or when rate cuts should happen. The only the outlier that's been the outlier for quite a while is Dingra, who'd been calling for no change in rates for quite a while now, and also with her previous counterpart or previous colleague who we had as Tenrero from the Bank of England, who was also calling for no change. But now everyone has kind of caught up with her, if we put it that way, all looking for no change with the rates. And that's normal. You'll have a variety of differing views from central bank members, so it's not out of the blue. The only thing that would be out of the blue today would be if the votes do matter when it comes to the rate decision for the Bank of England too. So you have 3 risks to be aware of: the votes, the rate, and the rate statement itself. So as said, economists are expecting a 6-3 vote with the rate to remain unchanged. But any one of those 3 could add more volatility to the markets. So it's a triple entendre that we have to be careful of. And the first one, which is obvious, is the rate, but that's kind of put to the side because markets are expecting no change. The second one is the votes. If more members are looking to, let's say, if Ramsden decides to go more hawkish in his expectation in looking for more tightening, then that would make it 4 members of the Bank of England rather than 3 that are looking to hike rates. And that could spur some strength in the pound instead, if the markets are expecting the majority of the Bank of England or a large majority of the Bank of England to keep rates unchanged. On the flip side, if you have a couple of members, let's say with Breeden, that decides that let's say with Dingra, who votes for a rate cut, okay, if from going from no change, that can then provide some bearish reaction for the pound, because that's not what the markets are expecting. What the markets are expecting is no change from in the vote for Dingra. But again, she could decide to say, okay, I will vote for a cut this time round, because of what she cited in the past, that the effects of rates are yet to come through, and there's already an impact that's being had on the economy so far. So that's the surprise there that could lead to the pound seeing some weakening as well. Okay, is that clear? Easy and Jab says, hi Tony, so far this week your analysis gave me good entries and confirmed my bias, both CPI and FMC. Let's finish the week with a bang. Yes, let's do. And by the way, if you've liked these videos so far, if you've liked this video, don't forget to give it a like, share the video, subscribe to the channel, get the word out there, share it with your fellow friends and traders, and get them in on the action too, and the knowledge that I'm dropping here, or the analysis that I'm dropping here for you guys. says the BV has been a bit behind the US, and they're basically doing the same thing. Most likely they're just going to be neutral to dovish, most likely to how the British economy is going. Well, that's we'll kind of go through some of the other comments that have been made by the central bankers and what the investment banks are looking for. But so yeah, that's the sentiment there. So Bank of England's Governor Bailey and other comments. So Bailey said on December 6th that the full impact of higher rates are yet to hit the UK. Ramsden, post the last rate decision, said that higher for longer is a message from central banks. Dingra said that food price inflation may rise again. Bank of England's Mann said, I would like to see rates higher than they are now, and monetary policy has only recently become restrictive, and not by so much. So remember, she's one of the hawkish members of the central bank, so that does make sense for her to say that, but she also hasn't seen inflation have a nice easy ride or a nice easy journey of disinflation within the UK. So it kind of makes sense that she would want to see higher rates to try and keep inflation under control and under wraps and stop it from either going down too slowly or seeing bumps in the road here and there. Green said that Bank of England's Green said the policy is less restrictive than we thought, and I'm concerned that a soft landing might go wrong in the UK. And Bank of England's Haskell said the current outlook does not suggest a scope for moderation in rates anytime soon. And also said in the Times interview, said that low unemployment may keep rates high. So this is also another thing to be aware of what could be cited within the Bank of England rate statement is about the labour market within the UK. The labour market in the UK, it's been okay. It's not been stellar. You haven't seen very strong figures from the labour market, but it's been decent enough so far for the central bank to not be that concerned with a potential deterioration of the labour market, enough for them to then switch their tune or pivot or talk about pivoting sooner towards a rate cutting cycle. Inflation is still, is still much higher than what the central bank's 2% goal is. So there's still a lot of work to do or confidence that needs to be provided to the central bank to make them feel confident that the inflation data will continue to head down. And then once it heads down to, let's say, about 3 or 3% or so, then they can kind of not completely relax, but feel much better about the work that their interest rates are doing. If it's not enough, you could potentially see another hike from the central bank. If they decide to go out, like, end the year with a bang, or on that bombshell, good night, if that's what they decide to do. But yeah, so that's a summary of the comments then from the central bank members. Now, investment bank and market views. So the Bank of England, their view on rate bets of what the markets have been looking at. So while none of the economists had been surveyed or that had made discussions last week expect a change in the key lending rate on Thursday, the Bank of England is concerned that markets were pricing in 80 basis points of easing in 2024. Now it's at 100 basis points from yesterday. And that was up from 50. So back when the survey was made after their last decision 6 weeks ago. So those bets are loosening financial conditions and reducing the impact of monetary tightening that the Bank of England has delivered. So remember, the currency matters. If the currency becomes weaker, things become cheaper within the UK. That's something. So what the central bank wants to see is that they want tight credit conditions or tight conditions within the UK to then see a depreciation within the UK's economy. And if the markets are betting on rate cuts too early, then that will then disrupt what the central bank will need to do in the future, and may mean that they have to put off the idea of rate cuts further down the line if the currency is depreciating itself before the central bank has delivered any rate cuts, or when they do decide to deliver rate cuts. So that's one thing that the Bank of England is viewing, how the markets could be disrupting or could be having an effect on what the central bank's target and goals are. Rabobank, they comment saying that they expect to see some pushback on the pricing in the form of hawkish with the pricing of central bank cutting rates by 80 basis points and now 100 basis points. So they said they expect to see some pushback on this pricing in the form of a hawkish split and some stern words. That's according to Stefan Koopman, so a senior macro strategist at Rabobank, saying that having been so unlucky with inflation in 21-22, we think the MPC will remain wedded to a higher for longer strategy until it becomes painfully obvious that it isn't tenable. So sticking to 5.25% for a longer period than what markets may be expecting, and then those traders who have made those bets on the central bank cutting rates in 2024, in mid-2024, would start to be pushed out of the window a bit more until they're on the cliff of an edge, until they're on the edge, and then the idea of a rate cut in 2024 is completely pushed out. That's a potential scenario that could happen. Deutsche Bank then say that much like in November 2022, when the MPC saw market pricing running ahead of itself, the committee may feel emboldened to push back explicitly on market pricing. While not our base case scenario, the more market prices in the rate cuts, we think the higher probability that the bank pushes back. Now, the GDP data that we had for the estimate data for the monthly figures for GDP. So the details of the report indicate that it was a pretty broad-based downturn, with services, manufacturing, and construction all contracting. So JP Morgan's comments after the data had come out, they had one of their analysts, Alan Monks, had actually lowered their forecast for the fourth quarter, and that the UK growth from 1%, changing UK growth from 1% to 0%, and warned that a negative quarter was coming unless activity rebounded in November and December. Goldman Sachs, they also mentioned post the GDP data as well, that they cut the 2023 outlook for GDP growth forecast to spot 5% versus spot 6% previously, and as well as cutting the 2024 forecast to spot 6% from spot 7%. And then JP Morgan on November 22nd, earlier on, they saw that the Bank of England delivering 50 basis points of interest rate cuts in Q4 2024 compared to a pause throughout the 2024 expected earlier. So they've had also upgraded their expectation of bets or rate cut bets for the Bank of England in the year ahead. Market pricing. So you had traders on November 15th adding two bets to after the CPI data of 80 base points priced in for 2024. 23rd, interest rate swaps reduced expectation for the first Bank of England rate cut, not fully priced in until September 2024. The OECD kind of surprised me here, but it might be a possible scenario. They don't expect the Bank of England rate cuts before early 2025. Part of that could be because of how the markets are pricing in rate bets for next year. That could be, and the idea of a pushback from the central bank could be putting off when the central bank decides to cut interest rates. It's not just what the market bets are doing. There's also the inflation issue that the central bank has itself for bringing inflation back down to 2%. But if you already have the other investment banks that are looking for rate cuts in 2024 rather than early 2025, kind of tend to lean towards what the markets are pricing in and what the investment banks are looking at rather than the OECD. They seem a bit delayed, and there's more trust that's put in what the markets are looking at compared to the OECD in this scenario. But that doesn't mean in the past where the central bank has been priced in to raise rates, let's say back at the end of last year, when they were expected to raise rates, that the central bank back then they decided not to raise rates, and they pushed back against those expectations. And then they said in the statement in the press conference that they would need to raise rates. So it's kind of dangling the lollipop in front of the kid and say, "Yeah, here you go," and whoosh, nope, and just take it straight away. So I think that's how the Bank of England kind of plays it. And the idea of rate cut bets, any comments of that would be the same. It will be the dangle of the carrot and stick, and then markets will try and bite, and then they'll just take it away until they actually feel like that they want to actually hand the carrot to whoever they want to hand it to. December 5th, interest rate swaps bring forward expectations for the first rate cut almost fully priced in for June 2024. For the 7th, according to polls, the Bank of England's hold rates through the second quarter 2024 unchanged from the November poll, but they're expected to cut the bank rate to 5% in Q3 of 2024 and 4.5% in Q4 versus 4.75% and 4.5%. So less rate cut bets had been expected or made back then on December 7th. And then 13th, traders fully priced in 100 basis points of Bank of England rate cuts in 2024. So let's look at the last rate decision. So this is about 10 seconds before that, and see what the market reaction was like. And if you have access to the Google ranges and deviations sheet, and go through what the sentiment was at that time. Well, what's going on here? Okay, so I was trying to get the ranges and deviations sheet up, but it's a bit slow. But you can see there that the pound had seen a strengthening. Again, if it was off the back of the 1 year and 2 year inflation expectations being raised. You can see that there in the headlines that had appeared. So those are the two headlines that had caused the pound to see strengthening. Now, if we if I kind of scroll forward and we see how much the markets were reacting, or how quickly the markets moved. We'll bring that back here. There we go. Okay. So you can see the markets did try and hold the reaction for a little bit. You can see on EuroGBP that the market reaction was near enough going back towards its prior levels before the release had occurred. But in the other currency pairs, there wasn't such a clean move back to prior levels, or they didn't move back until a while later. So if I get out of this video here, we'll look at the ranges deviations. Let's bring it here. Okay, here we go. So let's have a quick look. So here we go, the last time round on the 2nd of November. So the market reaction wasn't as strong as the last time around that it was. The only thing that sentiment-wise was the inflation expectations being raised for 1 and 3 year, and the Bank of England said that policymakers likely need to be restrictive for an extended period. So you can see the largest market reaction was within GBP JPY. In the past, you can see that it's been contested between GBP JPY and the GBP New Zealand dollar, which have had the largest market reactions in the past. And the last time around, it was GBP JPY. So that's going to be the main currency pair to focus that we're going to be looking at and keeping an eye on. But as said, so GBP JPY, the New Zealand dollar and Aussie dollar are also the other two that we got to keep an eye on for. But okay, if the central bank decides to upgrade the inflation expectations again to a higher figure, then that could lead to, again, another bullish reaction from the pound. If they see that disinflation is working and inflation is headed towards a 2% goal, and that they don't need to raise rates, or say that there isn't a need to raise rates at this meeting because inflation is heading towards a 2% goal, that could provide a bearish reaction for the pound, more or less confirming that the central bank is done with their inflation fight. And then we'll go through some of the other comments. So we've got about a minute, about less than 2 minutes to go. So just to clarify, if the central bank does decide to raise rates by 25 basis points, then that would mean a major shift in the central bank itself, in its voting pattern, and 2, that will then lead to a bullish reaction on the pound. But if the statement is dovish, on the flip side, saying that that's going to be the last rate hike that they do, or anything that's similar to that rhetoric, that they're more or less done, but they are prepared to raise rates again if needed, then that could moderate how much strength that the pound sees, if that were to be the case, if they did decide to raise rates at this meeting. Okay, we got 1 minute left to the rate decision. Let's get ready to rumble. So let's get TICKSTRIKE up and going. Okay. So I will go quiet for a little bit, just to let you guys know if you don't hear anything from me. Let's get TICKSTRIKE up and running. There we are. Right, I'm going to go quiet, guys. Speak to you in a bit. Okay, all right. So I am back. Okay, cool. Yeah, no, I did say I'll be away for about a minute or so, but I'm back. So I made one little trade there, and yeah, that's basically it. And on a second one, we'll see how this one kind of plays out. But okay, so overall, then a summary from the Bank of England. So the key points being there that you had the see inflation just under 4% by the forcible 5%, forcible 5%, forcible 5% by the end of 2023 compared to November's forecast, and around forcible 75% closer to 4% in February. Near-term inflation is somewhat lower than projected in November and reflecting energy prices. Measures of inflation persistence are higher in the UK than in other major advanced economies. So that's going to be one of the comments to take. That's going to be one of the comments would have led to the strengthening of the pound. The other one, most members say it's too early to conclude service inflation or pay growth on a firmly downward path. So again, that would be seen as a hawkish statement. And also, they raised their estimate for November fiscal plans. They say that staff provisionally estimate November fiscal plans will boost GDP by around 0.25% in the coming years. So, right, far away, but still a hawkish, slightly hawkish statement there from the Bank of England. So here we go. Traders pair bets, Bank of England rate cut bets, and see 113 basis points easing next year. Okay, so let's get out of there. Okay. What else we got? So yeah, now I'm done with those two trades. So the first one was better, got more out of it compared to this second one, but I think I'm not gonna take. I'm leaving the. I'm not gonna go for the carrot and the stick. So I'm done with the Bank of England. With the Bank of England, I am done with the Bank of England. I'm done with trading that for now. Okay. What else we got? Also, money markets here seeing trimming their 2024 Bank of England rate cuts, and now fully priced first rate cut in June as opposed to May. That's according to the Bank of England watch. Okay, so all right. So yeah, slightly more hawkish than expected Bank of England rate decision. Let's see what we got on GPUSD. So about 48 and a half pips towards the upside. GPJPY, which had seen the large market reaction last time round. Let's see how much that was up by. Whoops, I think I just mismeasured that. Whoops, it's going to be bigger than that. So there we go, about 63 and a half pips towards the upside there on GPJPY. GBAUD, so we did, which is what I traded this time round. It's about 60 or 59 and a half pips towards the upside. Okay, so yeah, there we go. X2UL, what are you saying? Time to walk through the snow. No easing tools broken out yet. Oh, easing talk is not good enough. Yeah. To be honest, it didn't really. they didn't mention any of it. So from what we've seen here, no mention of easing talks. So yeah, that would also provide some bullish sentiment for the pound. Still going higher. All right. So that concludes the first part of this live stream. So don't forget, if you want access to the one of the things I didn't get to do was talk to you about MacroAce. So MacroAce, with the deviations and ranges Google Sheet that I provided you guys, or that are provided in the past. If you want access to it, then all you've got to do is subscribe to the. Whoops. There we go. I subscribe to the MacroAce main list. So again, let me bring up the ranges and deviations. So if you forgot what I'm talking about, if you haven't seen it before, the ranges and deviations basically shows you how much the markets have reacted to economic releases. And if we're looking to the Bank of England as our current example here, you'll be able to get access to be able to see that in real time. So when I do make updates, you'll be able to see those updates in real time when I do those. Also, don't forget to like the video, subscribe to the channel, get the word out there. We still have the ECB rate decision to cover, and that's in about 35 minutes. I'll be covering them. But as said, so with the live stream here, or with the live that I'm showing you here, with the ranges and deviations, as said, it shows you how big the market reactions have been to the economic releases. And it's not just on the Bank of England, but of course we had the FMC yesterday, and we also do other releases. We have the CPI data too. It's been a bit of a busy week for us at MacroAce. But that's all there in one place. So now let's do an explanation of how the markets, or what are these figures here? What do they mean? So this first figure that I'm highlighting here shows you the initial market reaction going to the wick of the candle. Okay. And then the figure in the black brackets here shows you the market reaction 10 minutes after the release has occurred. And in the blue, and then in the blue brackets, if you might not be able to see the blue highlight, but in the blue brackets, so that represents the market reaction 30 minutes after the release has occurred. Okay, so of course that was one of our user requests. They wanted to see the 30-minute market reaction, as of course that can also be markets can still move, as we had with yesterday from the FMC. It was the S&P 500 was still powering on and going higher. It hasn't clawed back. It hasn't gone back to its prior levels prior to the release last night, which is always a nice thing to see, rather than a quick flash in the pan reaction. If the central bank provides more or less a no cheese in the sandwich statement, or it is what I like to call it. But yeah, so this is all completely free, and as said, I update this in real time. That you're able to see that there in the deviations and ranges sheet. All you got to do is subscribe to the MacroAce main list. You will get an email Monday morning for the week ahead. Now, of course, it's Christmas period, so there's nothing that we're going to be covering next week. But if you want to be able to see the past market reactions for the other economic releases, then you will have access to it Monday morning when I send out that email. I send one email every week, peeps. We don't always cover all economic releases. We only look at the economic releases that are going to provide the most volatility, opportunity, and provide you these sentiments and what to expect from it in the email. So in the email, what is also provided is a week ahead of the Europe, Asia, and US session. Very briefly, there's not a lot of information that is put in there because I go through that information for the upcoming economic releases in these live streams. So it's supposed to act as more of a refresher of what to expect for the week ahead. Actually, one other thing that I did want to show people is... Well, let me see if I can grab it up on here. But some people might be getting confused that when they do receive the email on the Monday, that they don't know where to find the ranges or deviations sheet. So in the email, there's a black button which will say ranges and deviations. Usually be above the live stream button if there is any live streams that we're going to be covering for that week. If you click on that, that will take you directly to this here, and you'll be able to see everything all in one place. And I said you get live updates for it. And did I mention, or did I not mention, it's completely free. Okay, so valuable information that you can use to figure out what you want to do, depending on what the sentiment is. So for interest rates, there's sentiment provided. Economic releases, there isn't sentiment provided. It's just the figures, because interest rates are more difficult to underpin, and you have to read into them a bit more to then understand what you're gonna do, brother. Okay, so that's the ranges and deviations. So we've got the ECB coming up in at about 30 minutes or so. So we're done here with the Bank of England, and also don't forget, if you've never come across FinancialJuice, FinancialJuice is a live real-time voice and text service, allowing you to stay in the know of what's moving the markets, the global geopolitical news that comes out. So you can stay up to that, all of that in one place as well. The key thing as a day trader is being able to capitalize on those potential market moving bits of news that could occur. And having a live voice and text service allows you to, one, manage your risk, and two, capitalize on those potential opportunities that could appear. So if I just show you in this market moving bit here, what we've seen in the past, or when we're particularly talking about headlines. Okay, so if we kind of go down, so we had the Bitcoin headline, which moved the crypto headline, which moved Bitcoin. We gave it some positive momentum. You had the Bank Japan with their comments saying little need that they are said to see little need to end negative rates in December. All these comments are examples of why news is important to keep an eye out on. It doesn't mean that it's going to happen all the time, that you're going to get these big breaking bits of news or very important market moving news. But when they do happen, it matters that you need to keep an eye out on the news, because if something does happen and you're not sure why, you'll know why with a live voice and text service with us. Okay, so here on the left-hand side, on the right-hand side, you have your voice service here on the stream, where you can see me dragging the little slider. Okay, in the center, you have your text headlines. So I'm just going to click on my news again. You have your text headlines here. In the middle, again, this is all live and in real time. And on the left-hand side, you have your economic releases for the week ahead, all in one place. So if you want to subscribe to FinancialJuice, but you've never come across it, first sign up, make an account. You will be on the light version of FinancialJuice, which has a delay, and that's a delay across the site. You had adverts that are played as well, and advert banners that appear. But saying that, if you've never used or come across the live voice and text service ever before, it's free. So there's no harm in finding out what it's all about. If that's something that you might pique your interest, or you might have thought, well, it's not going to work for me, have a little go. If it works for you, great. If it doesn't, that's perfectly fine too. But the free version, of course, means you only when you're ready and you feel confident that it can be added to your trading strategy, then go ahead and then add that, and then you can subscribe to FinancialJuice Pro, which will then give you this lovely view that I see here on my feed. Now, if you want to go straight to Pro, then just make sure you have an account first on FinancialJuice, okay? That you've got your login, and that you've got your own login deets, and that you've verified your email from the email that would have been sent to you when you first signed up. Then here there will be a button where you can kind of see me clicking away. Whoops. There'll be a button there which says Go Pro. Once you've selected Go Pro, Then you can select your subscription. Once you've selected your subscription, then just sign out and then sign in again. And then you'll be able to see the pro version of Financial Juice all in one place. Okay. Thank you very much, for your for the little ad that you put in there. Yeah, let me just bring that up. Hold on, give me a second. Yeah. So, so with my news, also this is also another key cool feature as well. So with my news, so FinancialJuice, not only do we provide the live voice and text data for our headlines, but we're also curators of news as well. So you can also have a look at the different providers that are out there and also add them to your news feed. So whenever they put out an article, the article will then appear in your news feed here. Okay, so I've kind of got mine very, very bare at the moment, but yeah. So that's another thing that you can do. So if you clicked on the little cog here next to the My News button, you'll be able to see and chop and change and add who you can subscribe to or add to your list. And those are free as well. They're not additional costs. Again, we're just curating them all in one place. So you can also have a look at those guys as well and make them part of your feed whenever they put out articles. Okay. All right. So does the GFX says, does the pro version come with the charts and the layouts? So with the charts and layouts, you're talking about the market reactions. So if you're talking about the market reactions, you can see in the feed, as for both pro and light users of FinancialJuice, that you're able to see that. The only difference between the pro and light version is that the light version is delayed and you have adverts that play with advert banners that come through as well. And also you don't have access to the news desk, which is asking us questions about what's happened, what the markets are doing, what the markets have done, and why the markets might have reacted in that way. Okay, so that is FinancialJuice. I will see you guys in about 20 minutes or so. I'm just going to get ready for the ECB, so I will speak to you guys shortly. As expected, inflation is still expected to stay too high for too long, and domestic price pressures remain strong. Past interest rate increases continue to be transmitted forcefully into financing conditions. Future decisions will ensure that its policy rates will be set at sufficiently restrictive levels for as long as necessary. In the ECB survey, they see inflation at, according to SPF, they saw inflation at 2.7% in 2024, unchanged from the last survey, and 2025 seen at 2.1% compared to 2.2%. The 5th of December, they had seen expectations for economic growth over the next 12 months became marginally more negative. And the ECB meeting minutes from the 23rd of November, it said, so it was maintained that given the current outlook, it could be expected that the Governing Council would be able to bring back inflation to its target, a 2% target, by 2025. Further hikes are not part of the current baseline scenario. Members saw more economic uncertainty than in September. Governing Council should be ready on the basis of ongoing assessment for further interest rate hikes if required. Then comments from central bank members. So on the 31st of October from ECB's Kazakh, he said that ECB rate cuts would need a dramatic turnaround in the economy. So they would need to see a dramatic turnaround in the economy now for them to consider rate cuts. Nagel said that we must not let up too soon and rates must be sufficiently high for sufficiently long. November 23rd, you had ECB's Villeroy, who said that the ECB won't raise rates again, and that's excluding surprises. Schnabel also said on the 5th of December that soft data suggests that the economy may be bottoming out and there is no prolonged recession seen. Further rate hikes are rather unlikely after the November inflation print. So also you had another comment from ECB's Villeroy, who also said that disinflation is even faster than expected. And off of the back of that comment from ECB's Villeroy on December 1st, that led to the euro weakening off of that comment there. So again, he had said that disinflation is even faster than expected. ECB's President Lagarde said that we expect weakening of inflationary pressures to continue. Then this is something that's always very useful to look at for the expectations of what could be said by the ECB and what kind of different scenarios that could affect the euro dollar and the 10-year Bund. So their base case scenario of what they're expecting the ECB to say at their upcoming rate statement, rate decision. So for the inflation outlook, they see that the ECB could say inflation revised lower, but risks from rising wages have been highlighted. Growth outlook, that growth revised lower, activity is still expected to recover in the long run. In regard to interest rates, keeping rates unchanged at 4.5 for the interest rate and 4% for the deposit rate, and being data dependent, and also hinting that a hike is no longer likely and cutting and pushing against rate cuts. And then finally, with other monetary policy tools, a discussion about shrinking PEP, but no announcement. So this is one thing that we need to, the way we kind of look at it, or should be looking at it, is what are the extremes then of what the ECB is expected to say, or what they could say, according to ING's different scenarios that they present. So if we have a look at the dovish, part, then here, where they see medium term, one of the things that could come out from if the central bank was being very if they were to be dovish, that medium term inflation may return to target earlier than previously thought. This could lead to the euro. Of course, if they are more dovish in their comments, that will lead to the euro seeing a bearish reaction. And then in regards to growth outlook, saying the evidence of more sustained slowdown in the economic outlook. No, in regards to interest rates, no hike at this meeting. Peak in rates has been hit, and the discussion of timing of rate cuts is also happening, or will happen as well. So these are going to be quite key, or what the central bank, when we're looking at the difference in the previous statement from the central bank and the upcoming one. Is there a difference? How much of a difference is there? Are they more hawkish or dovish? So looking at the dovish side, again, bring up the discussion of timing of rate cuts, and that inflation is going to, medium-term inflation might return to target earlier than previously thought. So whenever they say medium-term inflation, that's usually a period of over 18 months or so, is when they're talking about that sort of time period, that length. Okay, and then on the very hawkish side, they say that there is a high chance that 2% target will only be hit in 2026. And then they deliver, if we're looking at the hike side and the interest rate side, they deliver another 25 basis point hike, and they are saying that they're data dependent for further rate decisions. So that would be a flip from what a lot of the central bank members have said from the ECB, or the majority of them, that they would be more or less in favor of keeping rates where they are and just keeping them there for a longer period of time until inflation is solidly on its way to the 2% goal, which it is so far within the Eurozone for the headline inflation data. For the core, as said, is that it's still got a little bit of work to do, but it's still coming down quite nicely. So remember, it was at 3.6%, and then compared to the prior 4.2%. So it is making headways. So these are going to be. So if we're looking at what we're looking out for, we're looking out for the for volatility where it could creep in or jump in, is for the dovish stance and for the very hawkish stance, to give us a clear indication that there is a little bit of a surprise from what the current sentiment is for the ECB. And that's the same with any interest rate decision. It's always about what the central bank is, what the central bank's base case scenario is, what are the economists expecting and traders, and then when the rate comes out with the statement, does it deviate from what the expectation is? If it does, whether it be more dovish or more hawkish, that would provide more volatility to the markets, and hence you would get bigger moves from that increased volatility. But if we do get the base case scenario that does come out, then what we could see, what we had seen last time, is where the markets don't really move that much, and everything is more or less whatever's priced in happens, and you don't get a lot of movement out of it. So it becomes like a non-event in that way, when nothing's happened and everything's just the same, which is what happened last time around. There was nothing new, so the markets didn't really react in a way that showed that there was a change in sentiment. Okay. Then bets and expectations then. So October 26th, you had Goldman Sachs that said that the ECB rate cycle is complete, and they expect rate cuts from the bank to begin in the third quarter of 2024. And then on the 7th of December from Goldman Sachs too, they see April ECB rate cut on stronger inflation retreat. So they went from expecting the central bank to cut rates, start cutting rates in the third quarter, to now seeing the ECB starting to cut rates in April instead. Then Commerzbank, they say that they see the ECB will have to keep interest rates at high levels for a long time. So those three bets and expectations more or less suggest that the ECB isn't going to hike rates. But the key point from Goldman Sachs is that they see the ECB actually cutting rates before the FOMC does. So if you remember, traders were expecting the Federal Reserve to cut rates in March of next year. Goldman Sachs, looking to the ECB, expecting the ECB to start sooner. So they more or less could be the first central bank to cut their rates in the next year instead. And then November 3rd, you had money markets that fully priced 50 basis points of ECB rate cuts by July 2024. So there's a shift here, which is what I'm showing you, is that if money markets were pricing in rate cuts from November 3rd, now that those bets have actually increased for the ECB to be more dovish than they were in the past, because of how inflation has been better for the ECB's perspective, that things are working and inflation rates are coming down quicker than what some may have expected. As said, Villeroy, who made comments that disinflation has been quicker than he had expected, which led to the euro to decline. So the flip side, of where there would be a hawkish bias from the ECB, if there were to be, would be comments that inflation, that there isn't a there isn't a strong decline in inflation, or enough of a decline in inflation for the ECB to discuss interest rate cuts or the timing of interest rate cuts. That could be seen as very hawkish and very bullish for the euro in that case. And a very hawkish decision would be to raise rates by 25 basis points when the markets are not expecting the ECB to raise rates at this meeting. So again, as I said with the Bank of England and the FMC yesterday, it's all about what the expectation is and what the central bank delivers. Do they go above or below what the markets are expecting? Do they become more hawkish or more dovish than what the markets were expecting, where you get bigger moves that occur? It's also important to note what the central bank doesn't say either. If they don't mention the idea of rate cuts at all for next year, and they just stick to their current rhetoric of keeping rates higher for longer. Inflation is making headways, but it's still not enough for the central bank to, but it's still not enough for the central bank to consider anything else. And if they just kind of blow it off to the side, then you might not really get that much of a market reaction happening if it's all the same. And then on the 1st of December, traders fully priced in 125 basis points of ECB interest rate cuts in 2024. And December 6th, traders fully priced in 150 basis points of ECB interest rate cuts in 2024. So it grows as time goes on with the comments that the ECB members have made, and also how data has played out in the Eurozone area too. Deutsche Bank, so they see the ECB rate cuts in... They also see an ECB rate cut in April 2024 versus June previously as well. So then the idea of the ECB not talking about the timing of rate cuts at this meeting, if we consider the FMC, when Powell was talking about the potential for the timings of rate cuts, or that the discussion of rate cuts is more open, with members talking about when they see rate cuts happening. You're more or less kind of expecting, with this sort of timeline, with the expectations and bets that traders and investment banks are making, that the ECB would talk about the discussion being open for when rate cuts could be done. But if that doesn't happen, that could put traders off from pricing in a rate cut in the first half of 2024, and maybe those investment banks might push back their expectations for the beginning of a rate cut, or timings for the first rate cut, back to what they'd previously seen, maybe back to June, or maybe to a later, maybe a couple of months back, depending on how hawkish the central bank is within their statement. And so if we're in regards to the amount that Deutsche Bank expects the ECB to cut rates by, so they expect them to cut rates by 150 basis points in 2024 versus 100 basis points of cuts expected earlier. So this was the last rate decision here from the ECB back on October 26th. So this is about 7 seconds before that release had occurred. And you can see that there wasn't too much of a reaction if you're looking at the ranges and deviations sheet. So the data comes out as expected. You don't really get that much of a movement. Usually it can take a little bit of time for markets to digest what the central bank has said, and then their decisions, and then the market's decision is then made. But here you can see that the bunds in the bottom left-hand corner has started to see a bigger movement compared to, let's say, the currency pair, the currencies market, the FX market. You can see in the index, the stock index too, for the DAX, and also the Euro Stoxx 50. has started to see a move. So if we look at the ranges and deviations, actually first before I do that, I'll kind of skip across and we can see how much of a movement that there was overall. So in the currency space, you didn't really see that much of a reaction. You'd seen a slightly better reaction from the bunds and also on the bunds and on the DAX. But yeah, this is where we kind of ended up in the markets, because that was when GDP data had come out. So let's kind of get out of that. Okay, yeah, so that represents, so you can see the DAX still continue to push higher after that lackluster rate statement from the ECB. So let's get out of this here. Close that. Okay, let's go to ranges and deviations, and let's go through what was said. Like I said, there wasn't a lot that was said by the ECB. So here, you can see that the biggest move that happened within the markets in the currency space was on the euro dollar, and then second to that was the euro yen. But again, you can see how it didn't really last that long, and the moves weren't that big compared to if we're looking at the indexes. So for the DAX, you'd seen, as I said initially, 27 ticks towards the upside, and after about 10 minutes of trading, which is represented in the black bracket here, going to the end of the candle. So the first figure here goes to the wick of the candle, and then the figure in brackets here goes to the end of the candle. Okay, it was up to 25 ticks. And after about 30 minutes of trading, this being represented here in the blue brackets, the DAX was up by 86 ticks. And we've seen that when there has been, even when we had a surprise here, okay, when the ECB had raised rates by a bigger amount, the markets were starting to price that in anyways for a bigger rate hike for a rate hike from the ECB back then. So the market was a little bit choppy because there were still people that were pricing it in. It wasn't fully priced in for another rate hike. This time around, no one's pricing in a rate hike from the ECB at this meeting, considering how the bets have been made for some of the investment banks, as I said, like Deutsche Bank and Goldman, expecting a rate cut in April. So a rate hike at this meeting might not make sense for that to happen. So markets are expecting a dovish ECB. Depends how dovish they are. Do they open up the point that there is a discussion about rate cuts for 2024, or do they not? So you can see here from the sentiment that there was nothing new that was provided by the ECB. It was more of a repeat of the last rate decision. So here, the Governing Council considers that the key ECB interest rates have reached levels that, maintained for sufficiently long duration, will make a substantial contribution to a timely return. So that was more or less what was said at the last meeting, that kind of they'd keep rates where they are for a sufficiently long period of time. Okay, so we've got about 5 minutes left, and let's close that here. Let's get ourselves ready and get up the DAX. Okay, all right. So there we are. So let me get the TICKSTRIKE up and running as well. Okay. Let's get our UE releases set. Okay. Okay. Cool. Okay. So don't forget, if you like the video so far, to give it a thumbs up, share the video, subscribe to the channel, get the word out there. And also, if you found the other the Bank of England rate statement or the rate decision prep that I did not too long ago. If you found that useful as well, then as said, do the same. Give the video a like, subscribe to the channel, and get the word out there for peeps. Okay, so there we are. Okay. All right, I'm just going to go quiet for a bit, and I'll be back in a second. But somebody did have a question. Guata Madani said, what will happen if ECB interest rates don't change? Then you're looking to the statement to see if they're more hawkish or dovish than expected. Do they, if they're more dovish, do they say that there's a discussion being open? A discussion has opened up about the timing of rate cuts, or if they're more hawkish, an example would be, do they see that the inflation isn't coming down as quickly as they would have wanted it to towards the 2% goal? Maybe it will reach 2% in 2026, according to ING and their different scenarios that they presented. Or, do they expect that for the economy too, that the economy is still is stronger than they would have expected previously? And on the flip side, for the dovish side, if they expect the economy to be weaker than what they expected it to be, with GDP and spending within the consumer spending within the Eurozone. Okay, right. About 3 minutes left. I'm going to go silent again. Okay, less than a minute to go till we get the rate decision from the ECB. And what I'll do before the rate does come out, I will be going quiet and just and then I will come back to you guys. But I'll leave the charts up here for you guys to watch and have a look at. And then what I'll do is I'll do a bit of an analysis of the comments then made by the ECB. Okay, so rates remaining unchanged as expected. The market reaction was a little lackluster. There isn't anything the whipsaw from the market reaction. From the statement, then, so they see GDP 0.6% compared to prior forecast 0.7. Regards to inflation, they see it. They see 2026 inflation excluding food and energy, 2.1%. Then where was the? They see inflation, headline inflation in 2026 at 1.9%. They'll continue to follow a data-dependent approach. Will set rates at sufficiently restrictive levels. There wasn't really anything new, really. They did mention that over the second half of the year, they intend to reduce PEP portfolio by 7.5 billion euros per month on an average, which isn't unexpected. So they're expected to start reducing their PEP portfolio in 2024. Interest rate increases continue to be transmitted forcefully to the economy. Eurosystem staff expect economic growth to remain subdued in the near term. So yeah, it's more of a whipsaw reaction here from the market. So there isn't really a lot that's outstanding here from the ECB. Probably the only comment to take of note is that they expect inflation at 1.9% in 2026. From that, there isn't really a lot from the ECB in that regard. And that basically concludes the ECB rate decision. So, yeah, a little bit lackluster with the statement. And the only slightly hawkish point being that they expect inflation to reach 1.9% in 2026. And what we got here. Okay, so currently got that going on there. Okay, done. Nice. Cool. Yeah, and then also with the core inflation. So the other key point that sticks out is they see 2026, excluding food and energy, inflation at 2.1% in 2026. So nothing else there other than those 2 points. So it's going to take a slightly longer time for the ECB to reach their 2% inflation target. Hence, you see some strength from the euro there, off the back of that news. Other than that, there isn't really anything else from that report, from that statement, should I say? Okay, that concludes the live stream then for MacroAce. Thank you very much for joining us live. I hope you found the information useful. And as said, don't forget to like the video, subscribe to the channel, get the word out there, subscribe to the MacroAce mailing list. So next week we won't be covering any economic releases. That concludes MacroAce for the year. But yeah, so next week I'll be providing the deviations and ranges as normal and what to expect for the week ahead. But it probably won't be that much, to be honest. So other than the Bank of Japan and their rate decision, are they going to follow what markets were expecting beforehand? Will they expect the Bank of Japan to get out of the negative rate territory, or what the Bank of Japan said earlier on themselves, or what they are said to be saying? I'll just bring it back up. Let me get this out of the way. Where are we? Here we go. So again, or will they just, if they said to see little need to end negative rates in December, will they kind of just stick to that and keep rates where they are in the negative territory, a minus 0.1%? To me, personally, it seems a bit too soon for the Bank of Japan to maybe raise rates at this point. If you've already had comments creeping in that the Bank of Japan sees little need to end negative rates in December, and considering how slow the Bank of Japan is themselves to what the markets expect. So if it is with the if it is with their bond market and where they would expect the next limit to be, or whether they raise it or not. Again, those sort of things have taken longer than expected for the Bank of Japan to kind of reach that sort of decision. So anyway, that's a personal view of mine with the Bank of Japan. They're quite slow, and I don't think that they're that likely to raise rates in December. But again, those thoughts could change depending on what the Bank of Japan says, but there hasn't really been anything to suggest the central bank would do that. But for now, enjoy the rest of your week, enjoy your weekend, and I will speak to you guys soon, probably in the new year. All right, but thank you very much for joining us, and I will speak to you next time.